How can you turn a small investment of $25 a week into a $5,000 monthly salary? Imagine this. With just $25 invested each week, you could potentially build a portfolio worth over $500,000, pulling in more than $5,000 a month. It might sound impossible, but it's achievable with the DRIP strategy, Dividend Reinvestment Plan. Think of it as planting a tiny seed and nurturing it to grow into a towering financial tree. Instead of pocketing those dividends, you reinvest them to buy more shares, and over time, this process creates a powerful cycle of growth. It's like starting with a snowball at the top of a hill and watching it grow into an avalanche of cash. So, what exactly is the DRIP? It's pretty straightforward. You invest in dividend-paying stocks, and instead of taking those dividends as cash, you reinvest them to purchase additional shares. This means your investment benefits from two sources of growth: the appreciation of the shares and the increasing number of shares you own. The more shares you have, the more dividends you receive, which you then reinvest. It's like feeding a growing beast, except this one gets richer and more powerful, not hungrier. Let's break it down with a simple example. Let's say you own 100 shares of a company, each worth $20, and the company pays a $1 dividend per share each year. By reinvesting that $100 dividend, you could buy an additional 5 shares by the end of the year. Now you own 105 shares. The next year, instead of receiving $100 in dividends, you'll get $105 because you have more shares. The cycle continues, with each year's dividends buying even more shares, which generate even more dividends. In the end, I'll show how this DRIP strategy can turn a modest $25 weekly investment into over $5,000 per month and potentially build a portfolio worth more than $500,000. Now, the real charm of DRIP lies in its ability to harness the power of compound interest. With each reinvestment, you're effectively purchasing more shares, which then generate more dividends. This compounding effect means your investment grows at an accelerating rate, turning what starts as a small investment into something significantly larger. And your financial snowball keeps rolling downhill, gaining size and speed with every turn. Another great benefit of DRIP is dollar cost averaging. This approach involves investing a fixed amount regularly, regardless of market conditions. Think of it like buying groceries every week. Sometimes you get a great deal, and other times, not so much. Over time, this approach smooths out the impact of market fluctuations, allowing you to purchase shares at an average price rather than trying to time the market perfectly. It reduces the risk of making poor investment decisions based on short-term market movements. One of the most appealing aspects of DRIP is its convenience. Once you set up a DRIP with your broker, it automatically reinvests your dividends, so you don't have to worry about making manual purchases or timing the market. It's like having a personal assistant managing your investments, minus the office gossip and coffee runs. But to make the most of this strategy, you have to improve it. That's why selecting the right stocks is crucial. And before anything else, I've got a great resource to help you with this. Check out Road to Successful Investing. This is a stock investing guidebook priced at just $39 that covers everything you need to know before buying your first stock. There's 15 beginner-friendly chapters and a 60-day money-back guarantee. Plus, you can preview the guidebook before you buy. I'll leave the link in the description below if you want to have a look. You'll want to focus on stocks that fit certain criteria to ensure your investments grow steadily. Here's a breakdown of the categories to consider. Blue chip stocks. These are shares in large, well-established companies known for their stability and reliability. Think of companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. They're the rock stars of the stock market, steady performers that provide a solid foundation for your portfolio. Dividend aristocrats. These are companies that have increased their dividends for at least 25 consecutive years. They're like the seasoned pros of the dividend world. Examples include AT&T, ExxonMobil, and Walmart. Their long track record of consistent performance and dividend increases makes them a great choice for stability. High-yield dividend stocks. These stocks offer higher than average dividend yields, making them attractive for income-focused investors. Think Realty Income Corporation, ABV Inc., and Verizon Communications. While they might be a bit riskier compared to blue-chip stocks or dividend aristocrats, they can add an extra layer of income to your portfolio. Growth-oriented dividend stocks. These are companies with strong growth prospects that also provide dividends. They're the unicorns of the stock market, offering both capital appreciation and income. Examples include Microsoft, Apple, and Visa. They combine the benefits of growth and dividends, potentially offering the best of both worlds. By blending these types of stocks into your DRIP strategy, you create a diversified portfolio that balances stability, income, and growth. For example, a portfolio with blue-chip stocks provides reliability, dividend aristocrats offer consistency, high-yield stocks boost income, and growth-oriented stocks add potential for appreciation. Let's see how this strategy could play out in practice. Suppose you decide to invest $25 every week, totaling $100 a month or $1,200 a year. Over time, this small but consistent investment could grow significantly. For instance, if you consistently invest $25 each week into a well-chosen portfolio, in 10 years, your investment could potentially reach around $27,000. Stick with it for 30 years, and your portfolio might be worth over $823,000, generating annual dividends of approximately $63,000. That's over $5,000 a month. And this is how your little snowball of $25 a week turns into a powerful avalanche of financial returns that could fund some serious life goals. The key to this strategy is consistency. By sticking to your $25 weekly investment and reinvesting the dividends, you're harnessing the power of compound interest and dollar cost averaging. Your investment grows more rapidly over time, and you benefit from both the appreciation of your shares and the increasing dividends. The beauty of DRIP is that it allows you to build wealth passively. While you go about your life, whether that's chasing dreams, enjoying hobbies, or binge-watching your favorite shows, while your money is working for you. Also, don't forget to check the link in the description for the Road to Successful Investing ebook I mentioned in this video. I hope it helps you as much as it helped me. So now, are you ready to start building your portfolio? If you're interested in learning more about building your own dividend empire and reaching a $1 million portfolio, hit that subscribe button. Your path to financial freedom might just be a small weekly investment away. Take care and see you next week.